So we've heard the latest there on a possible rejoining on the TPP. In the meantime, also concerns easing slightly over the tensions in the Middle East and also over the trade tensions with China. But trade is going to remain a key theme for 2018?
I think it certainly should do. And maybe the lesson is we shouldn't overreact when news first comes out. There is a risk that you get jerked around by news stories. You know, we're good on trade, we're bad on trade. Clearly, the administration is more risk-taking in relation to trade than we've seen before. And I think that's created challenges for investors because the long-term risk of trade protectionism is very significant for equity investors. But it does seem like we're backing away from the worst outcome.
You say it's very significant for equity investors, and what we've seen is equity volatility sort of spike higher on all this, as opposed to fixed income and FX volatility. So do you think equity volatility might come down as the year progresses, or will FX and bond volatility rise to meet it, or are bond markets focused on something else like central banks?
Sure, it's a very good point. I think equity volatility at these levels is here to stay, or maybe a little higher. We went through a very unusual period of very low volatility. We're in a period where fixed income volatility is very low. And that's a puzzle for market participants. I think currency volatility will rise because often it's the area that takes the strain. And I think, frankly, where you've got these big geopolitical shifts, I think we should expect currencies to be risky. And therefore, thinking about prudent hedging policies and trying to match, a long-term policy with short-term protection is very important, particularly in currency.
Yeah, and speaking of risk, let me just take you to a chart showing that despite the trade tiffs and also the tensions around the Middle East, US and Syria, the market risk indicator remaining fairly low if you look at the Bank of America Merrill Lynch GFSI market risk. I mean, this does come with a bit of a lag, 48 hours or so, but you get the picture. When it comes to risk and allocating around risk, is it time to take risk off the table? I spoke to Dan Iverson actually on a panel at the UBS Global Wealth Management Investment Summit yesterday, and it was one of the things he pointed to, that perhaps it's time to de-risk a little bit. Is it time for that, or just be more prudent about how you allocate risk?
I think you've got to be dynamic with risk. We use a risk indicator to measure the environment across all asset classes. And we find that useful to not necessarily as a timing signal, but as a budgeting signal. And right now, we wouldn't be risk off. But we'd certainly be using a prudent approach when it comes to how much we're going to spend in our risk budget, because there may be better times. So better times may be a better valuation or a better risk environment. I think we've seen a normalization, frankly, of risk environment. We're not in a high-risk environment at all.
And when it comes to how central banks, their reaction function to all this, I mean, we heard in the minutes from the Fed, also the minutes from the ECB, that trade tensions are weighing on policymakers' minds. Do you see them perhaps sort of stepping back a little bit from the normalization? Or is this going to, for example, fuel inflation in the US, and then we could actually see tighter policy than expected from the Fed?
Yeah, I think in the US that the momentum in real activity is strong enough that central banks are likely to stick to their original course. But I do think they're concerned, and everything I've heard suggests that they're at least as concerned as market participants about the risk of trade protectionism, and therefore they want to have a little bit in reserve. But I don't think they want to jump the gun. I made the point about not being jerked around by short-term news. They're in the same category of market evaluators as we are, and I think they don't want to overreact.
The other thing about volatility is, you've pointed out, Rick, there are different types of volatility. So how do you play those different types of volatility?
Well, it's not like good cholesterol and bad cholesterol, but certainly if you have very low volatility, that can be dangerous for many reasons. Most of the excesses we have in credit markets in particular are caused by people feeling very relaxed. So a return to higher levels of volatility in equity, which feeds through to credit, is actually a pretty healthy thing. And you've got to ask as an investor, am I getting rewarded for the volatility? And if the volatility is, as we see it now, quite broadly based, it's not narrowly focused in a few clusters from a statistical perspective, then I think we should feel much more comfortable. And if you look at the equity market, which is a better environment now for active stock picking, I think it's an area where rewards will come from risk taking. So I think we are moving into a slightly better environment from a fundamentally active perspective than we've been in the past.
Mm-hmm. And out of all the risks out there in terms of political and geopolitical risks, are there any that you're finding easier or more difficult to price?
Well, I think inflation risk is clearly a little bit of a puzzle. We're late cycle in the US, but we're certainly nowhere near it in the rest of the world, certainly in the Eurozone. And picking apart what's cyclical from what's a permanent effect is very hard. If you have a really hard protectionism strategy from US and China, that's a longer-term inflation risk. But what we're seeing now is maybe a little bit of a pickup, and maybe inflation becomes more of a talking point in 2019 than 18.
Ah, interesting. So some people are saying sort of it's not about if inflation is coming, it's when. So are you of that view too? It's when, and you're looking at 2019?
Well, again, it's when there's a normalization. Don't forget, we've spent the last 4, 5, 6 years talking about deflation and disinflation. So we're in a renormalizing world.